So I think there's really like 4 or 5 things that are most important when looking at a company or a project. The first one is the tech, and that's the opposite of what most VCs would start with. And in a Web 2.0 startup, I think you wouldn't look at tech first, but here you do, and I'll explain why in a bit. Second one is team. Third one's economics. Fourth is market, and fifth is product. Fifth is actually the most important, but the first 4 are table stakes to get to the fifth. So at Pantera, what we do is we invest in the cryptocurrency space. That's all we do. We do equity, we do ICOs, and we do liquid strategies. And so if you look at venture, some projects don't actually need a token. This is a slide that's kind of confusing. There you go. If you look at venture, some projects don't actually need a token. And if you think of a company like Coinbase, there's absolutely no reason for Coinbase to have a token associated with it. So that's just regular equity. And then you also see some projects starting to do equity raises before they launch a token. So that's another reason why VC makes sense. And then the last 2 are really just kind of things that make people feel comfortable but aren't necessarily actually true. And that's stability and low volatility. So if you're investing in private equity, you have perceived lower volatility than an asset class where everything's liquid and marked to market every day. Now, realistically, you're not actually hiding the risk. It's still there. But since your portfolio is only marked to market when companies either fail or have fundraising events, it looks like you have a really low volatility portfolio. And so because of the fact that you're locked up, that actually makes venture capital perceived as a safer asset class. So it's more of a psychological thing as opposed to reality. And so if you look at what areas we think this tech is going to disrupt, you have things like sharing economy plays. So disintermediating kind of rent-seeking incumbents that sit in the middle and take a cut of every transaction. So if you think of a company like Airbnb or Uber, what they are is basically multi-sided marketplaces where, Uber, you have people who have excess car capacity and they're lending it out to riders. Airbnb, you have the same thing but for homes and people who are renting them. And currently today, the irony is these are peer-to-peer platforms, but there's a big company in the middle that matches every transaction and takes a fat cut. And so if you think of blockchain tech, you could cut those companies out, replace them with a peer-to-peer order book built on something like Ethereum, and only pay for the services that are actually worth paying for. So in the case of Airbnb, that's probably something like arbitration, insurance, dispute resolution, that sort of stuff. And the same thing is actually true of Uber. The other area is more gaming or gambling use cases. And if you look at any new piece of technology, one of the first areas that people use it is for gambling and betting. And that's because people who want to do that activity have a high desire to do it. So if there's a way to make it better, they'll use it. And so you saw this early on the internet with online poker sites. And I think you're going to see the same thing with crypto, but with more traditional betting. So if you look at a company like Betfair or Paddy Power, they take anywhere from 5 to 10% in round-trip fees. If you cut that down to 1 to 2%, all of a sudden you have a much better proposition for both the bettor and for the market makers providing liquidity on those sites. So I think one way to frame it is betting and gambling is going to start to have fees similar to financial markets. So it's going to go down by an order of magnitude. Another area is like data exchange. This is a bit farther out there, and I'm actually less bullish on this area. But the idea is that instead of just giving all your data up for free to a company like Facebook, you'd actually have a marketplace where there's buyers and sellers, and you could sell your data and get compensated for it. That's probably much farther off, though, because one, those companies today, those incumbents have huge network effects, and two, the solution isn't really a true 10x better. If you can bet someplace and it's 10x cheaper, that's 10x better. Or if you can speculate on something that you couldn't ever speculate on before, that's a 10x better solution. But being able to sell your data for $5 a month isn't 10x better. And so if you look at our investment portfolio, we're basically investing globally. Almost half our deals are outside the United States. Or a third of our deals are outside the United States. Almost half of blockchain companies in general are outside the US. You see concentrations in Southeast Asia, We haven't invested a lot in China. I think that'll be an up-and-coming market, though, over the next few years. And then a lot in the United States. These are just countries we've been. There's lots of deal flow that you can find in the blockchain space traveling around the world. Like Omise Go, we found it in Thailand. And there's lots of startups that are just kind of created random places. And the reason is all these companies, not only are they decentralized like on the blockchain level, but a lot of them are also starting to be remote. So in the crypto space, you start to see companies that are remote first, as opposed to having an office first. It's probably one of the few sectors in tech where that's actually more common, whereas most places, you just have an office. These are some of the areas we're looking at on the venture capital side. So exchanges are still super relevant because one of the most relevant things is you have to have a cheap fiat on-ramps for this tech to work. Because we just talked about disintermediation and all these cutting out the middlemen. But if it costs 4% to get into crypto, you're basically just as bad as the traditional banking system, or probably even worse. So that status quo has to change. Fiat on-ramps for crypto have to go from 4% to 50 basis points. Otherwise, this stuff's not going to work, and no one's going to use it. So that's one big theme. Other ones are kind of general infrastructure. Pretty much everything on this slide is infrastructure. Custodians are really just infrastructure for institutions to get invested. Asset management infrastructure, research data, tools for institutions to actually trade in this asset class. That's another thing that's going to change over the next few years is right now, trading in cryptocurrency, the exchanges are very bad. They're very slow. You have seconds of latency, sometimes tens of seconds of latency in some extreme cases. And on Wall Street, you're used to microseconds. And so as exchanges get better, so will efficiency in the market get better. And then also fees will come down. So that's kind of one angle to it. But you also have the scalability angle. And so everyone talks about how decentralized applications only have 100 users, whatever. The problem is you can't get any users until you have scale. And the reason is this is not like the internet, where if you're Twitter, you can keep spinning up new servers. And sure, your site goes down once in a while, and you see the big fail whale on the site, and they spin up some more servers and keep repeating it until they have scalable infrastructure. It's not like that because all these things are multi-sided markets. And so if you look at market making, the way it works in regular exchanges, you're placing and canceling thousands of orders a second. And you're basically providing liquidity by doing that. And so the throughput of a network like Ethereum isn't even high enough to sustain active market making or active liquidity provisioning on a single decentralized application, let alone the hundreds that are building on top of it. So scalability is one of the big areas that the space really has to innovate on until we actually expect to see adoption. And the reason is liquidity begets liquidity. So it's very recursive. And so since there's no scale, you can't have any market makers. Since there's no market makers, you can't have liquidity. Since there's no liquidity, why would anybody show up? And that's why there's no users on dApps today, in my opinion. It all comes down to liquidity. And so if you look at our investment process, I basically just ignore this slide. But the first thing is, if you look at tech. So why do you look at tech first in this space? And the reason is, this space is right now is so nascent. It's much more like starting a rocket company or starting a biotech company than it is like starting the next Snapchat. And the reason is it's so low level, everything's open source, and security is paramount. So if you think of writing smart contracts on a platform like Ethereum, and you think about how that relates to the regular world, well, the development process is much more waterfall. You have to specify everything out in an insane amount of detail. So you write your spec, you code it up, and then once you've programmed it, it has to be secure. If there's one vulnerability in it, all the money in your contract can be stolen. So it's like if you're NASA, and when you wanted to launch a rocket, everyone could see the blueprints for your rocket, full open source. They could see all the source code for your rocket. And any adversarial nation state could try to call commands on your rocket to blow it up while it's going to space. That's the equivalent challenge of writing a secure smart contract today. And that's why there aren't that many that are live on the Ethereum mainnet, is it's really difficult, it's really time intensive, and the process of making sure that they're actually secure takes forever. As time goes on, people will build more and more layers of abstraction so that this becomes much easier. Eventually, computers will automatically find vulnerabilities in smart contracts. People have kind of really basic ways of doing that today, but it's not quite there yet. The other reason you look at the tech first is a lot of the stuff that we see pitched in this space is kind of the equivalent of telling a physicist, hey, we've created a way to have a perpetual motion machine, or hey, we have a way to do cold fusion. And usually people don't have a perpetual motion machine. And that's kind of the common thing in the blockchain space is everybody says, oh, we can do 1 million transactions per second. And well, that would kind of violate fundamental physical limits. You're constrained, your bandwidth is constrained by the speed of light. So even Visa only does about 50,000 transactions per second. So how could you do 1 million in a trustless peer-to-peer network? So people kind of come with all these proposals that don't actually make much sense, and so that's why you look at the tech first, because it's the fastest way to kind of weed out bad projects. The next thing you look at is the economics, and the economics is really important because blockchain tech is the first time that computer science and econ have really combined in any real sort of way. And so you have to look at the incentives of these things. If somebody's built a network where there's no reason for the token to exist, and in fact the network gains from removing the token, that's not a good project that you should invest in. Instead, you should focus on projects where the token is actually an integral part of the network. And so everybody says, well, our token's an integral part of the network. So the way to look at that is basically to ask yourself, if I'm a user of this thing, why would I want to use this token as opposed to using a currency that's pegged to the dollar? And unless there's a really good answer for that, the project's token probably doesn't actually make sense. So one answer could be, well, this token's required to secure the network. And if you remove it, the network's no longer secure. So without it, all of your money could be stolen. That's a great answer. But usually the answer is, well, we created this thing because we wanted to profit off of it, and it's a way to make payments in the network. That's the bad answer, because you should just use MakerDAO's DAI, which is a stable coin that is actually pegged to the dollar. And then the other fundamental thing with economics here is that you have to get the incentives right, otherwise your network can actually be attacked. And so if the incentives don't add up, people will execute attacks on your network. But they don't have to be perfect. If you look at Bitcoin, Bitcoin has incentive flaws. There's this thing called selfish mining where it actually makes sense to attack the network in a certain way. But in practice, it doesn't actually happen. So things don't have to be perfect. They just have to be, generally good or good enough. The next area is team, which is super important. But the first two things are kind of table stakes. If you don't have the first two, the team's probably not any good either. But then if you look at the team, it's a bit different than a regular company because teams in this space need to understand open source really well. If the team of a project doesn't understand open source, they'll just do things that don't make any sense in an open source world. And so the ideal kind of founder in this space isn't necessarily someone who led enterprise SaaS sales, because that would be a terrible person for creating a free open source software project. But somebody who's managed a community before, that could be very useful. Somebody who's contributed a lot to open source as a developer, that's also useful. Anything someone's done that's really kind of grassroots community building is typically useful in this space as a background. The other sorts of things that are important for a team are having people who really understand the tech. Because if you get the tech wrong, none of it works out. And you really also just want people who are honest. VCs, rarely actually list this in the kind of qualities they want from founders. But honesty is actually the most important one because there's a lot of companies that blow up due to the fact that the founders are dishonest. And you can actually test that really easily because if you have a company that you're talking to them, and you may not know everything about what they're doing, but there's probably some specific area of what they're doing that you know a lot about. So drill in on that area, and if they make something up that's kind of bullshit, call them out on it, and then see if they double down on it, or see if they decide to tell you the truth. And if people just start making stuff up, that's an automatic disqualifier because it kind of shows that the person isn't actually honest. There's a bunch of other things for team, and you can read, people have written books on this, so I'm not going to belabor the team point too much farther on this conversation. But the next thing is market. And so if you're going after a market, it should be a pretty large market if you're trying to get venture capitalists or hedge funds to invest in this space. Examples of a small market would be, I think the market for smart locks on blockchains is very small. It's something I wouldn't invest in. Markets for, decentralized finance, however, are huge. They're so huge that the numbers are kind of laughable. And And so market's pretty important, but the most important thing is product. And whatever you're building, you have to understand it really well. And if you're a team in a space where there's competitors, you need to understand it better than anybody else in that space. So if you're building, a decentralized financial application, but you have no finance background, you don't understand anything about finance, you're probably going to have a bad time. Whereas if you have a team that has people who understand the crypto part of it, understand how blockchains work, understand how to write smart contracts, understand the limits of blockchains, that's really important, but also people who understand the economics, understand game theory, understand how markets work, what makes a functional market. If you have all those things, then you have a really good team, and you have a really good chance of making a strong product. And I think one of the big challenges in this space right now is user experience. A lot of the products in this space are designed solely by developers without much actually talking to users. Some of it's just based on the fact that the space is so new, it's actually hard to design a product that is easy to use. So like scalability limits make designing products that are straightforward really hard. That's why everything's so slow in this space, because it's not scalable. If things were scalable, UX and UI would be much easier because things would happen much quicker. Whereas now on Ethereum, you have to wait 15 to 30 seconds for your transaction to go through. If you want to fetch a bunch of data from Ethereum, it takes a really long time. There's all these kind of constraints. But a lot of the UX issues are actually just things because the development team never actually bothered to talk to regular users. I think the worst example of this is, if you look at the primary way people sign on to decentralized apps today, they either are expected to use a hardware wallet, or they're expected to use MetaMask, or they have to install an extension in their browser. I'm technical, and I don't even like installing extensions in my browser. And if a technical person doesn't want to do it, how do you expect, your mom or your grandma to do it? It's just not going to happen. And so I think that's a big issue, is people don't pay attention to kind of like what actually needs to happen for this to make sense from an average user, for them to be willing to use it in a way that doesn't cause them to, pull their hair out. Those are kind of the important things on product that I think people aren't paying attention to enough in this space. Also with product, this space is interesting in the sense that you have a lot of trade-offs on compliance. And you have some companies that do compliance 100%, and sometimes the company gets killed because they're so slow on it. And then you have some companies that do no compliance, and sometimes the company gets killed because they did no compliance. And then you have some companies that are in the middle, and you have everything from every spectrum to the exact opposite of it. If you look at Binance, they obviously do not do very much compliance. If you look at a company like GDAX, they do a lot, but their volume is nothing in comparison to Binance. And so you have all these trade-offs to make. I think that's the most important thing people don't understand about this space is it's all about trade-offs. If you look at scalability, it's also all about trade-offs. Everyone talks about, payment channels or state channels or Lightning Network, if you've heard of that. And the big trade-off there is that you require a bunch of collateral to do your transactions. And so if you're transacting back and forth a bunch with one or two people, that works great because you're just doing payments. If you're doing anything in decentralized finance, like trading or betting or whatever it may be, that doesn't work very well because you have too much collateral required. If for every $100 you wanted to bet, you had to put $700 down, you would have just not used the app. So that's another thing in this space is there's a lot of people who kind of place too much precedence on theory and not enough on what's true in practice. So you could create a system that works perfectly in theory, but if it has some huge drawback that makes no one ever want to use it in practice, it's a worthless system, no matter how beautiful it is in theory. And to give you an idea for what sorts of things we're investing in, these are kind of the historical investments we made in our first and second venture funds. So if you look at them, they're primary ways to buy, store, and speculate on Bitcoin in the first fund. The second fund is a lot of infrastructure, lots of exchanges. We've invested in some scalability plays as well, like Starkware, which is using zero-knowledge proofs to scale. And then a few kind of enterprise blockchain plays. But I think the enterprise blockchain stuff is something that's kind of starting to fade into the background. The largest enterprise blockchain company, Chain, which we invested in, actually got acquired by Stellar, which is a public blockchain. So you can kind of see the irony in that. And I think that's basically it. I'm just going to end it here. I don't know if there's time for any questions, but happy to answer any questions people have if that's something.
Hello, that was a wonderful presentation. May I ask why did you disposition out of Bitstamp?
Why did we what?
Why did you sell your equity in Bitstamp?
Oh, well, so the company basically decided to sell. That wasn't a decision that we necessarily made. When we invest in a company, we kind of like to do what the founders want to do. I think lots of VCs will try to kind of run a company to zero or to tens of billions, but not enough people just kind of follow what the founders want. I think there's a lot of value in that because it gets founders on your side.
I never knew it would be a shy audience. Excellent stuff. Is there any last questions? Would that be all good? Yes, good stuff.
So a lot of VCs were flipping tokens at the peak of the ICO cycle, right? I mean, how much of the returns can be attributed to the flip versus actual quality venture investments?
Yeah, that's a good question. I'm not sure of what other funds' returns are from flipping. If you look at our funds, we've held the vast majority of our positions. So the way I think about it is much more long term. I think if you look at ICOs, at least ones that are actually good, they're positions that you want to be holding for periods of years. It actually looks much more like venture as opposed to flipping a quick buck. And the reason is it's going to be years before these things even have lots of users. It's probably 2 years until any decent amount of scalability is even here. Probably another 6 months before cheap fiat on-ramps are here. And so if you're a fund and you're selling positions before then, the only reason you're doing it is to flip it. It's not because something's fundamentally came out and launched and has great success, because that's not possible right now. But I think it will be over the next 12 to 18 months.